Hey everybody, how are you doing this Sunday? As usual, I just want to make sure that I am live because once we finish this, it'll go on YouTube, and I just want to make sure if you weren't able to make it tonight, you were able to actually see it on the replay. So let me just check, make sure we're live, and then also if you weren't able to make it tonight, you were able to actually see it. And want to make sure too that the audio is good. So if you guys could let me know if you're watching this video, let me know if the audio is coming in great or not. Because once, of course, it saves, I don't know if with the clipping or any type of sounds will kind of go about in the video. So, hey Dad, how you doing? Let me know if the audio is okay. Let me know if the audio is clear. Okay, it's good. All right. Because I'm using the mic tonight. So I just want to make sure the audio is good because I know last time I used this microphone, it was clipping. So I just want to make sure it doesn't sound clipping wise. But again, thank you guys. Welcome back to the channel. I appreciate your time. If you're new to the channel, don't forget to subscribe to the channel. Also, if you're a returning subscriber, I appreciate you being here every Sunday to join in conversation with us live. Also, don't forget to like and share. Remember, in order for us to push this content through the algorithm, we need you guys to like the content as well. And then also, don't forget to hit that notification bell to know when we are live on this YouTube platform. And we will jump right into it. So tonight, we are going to talk about two different things. We're going to go on two different sectors. One, we're going to talk about permitting with your home in certain states. Always look into that prior to selling to make sure you are not above any type of permitting restrictions or need to get permits for you to redo certain your property per se, or any type of repairs or renovations in your property. And then we're going to swing over to foreclosures, understand a little bit about the foreclosure process, understand about different things that's kind of occurring right now in foreclosure wise. Also, if you are new to the channel or if you are subscribed back at the channel, if you guys don't know, I am a real estate agent. So if you ever need any assistance as far as real estate, if you need me to refer you to anybody in a different state, I will be happy to help you. All you have to do is go down below into the profile or go to my main page and you can scroll down. You'll see my email there, or you can call me on my phone number to help assist you. Because I'm like, I got to say that because I don't never say it. So everybody's like, why don't you never tell people that you actually assist people in real estate transactions? So just wanted to make sure I said that. Okay, so let's jump into this first video. It's a young lady off of TikTok. I'm going to add her to the stage. Her name is called Where Did It Put My Hammer or something? I think I'm saying it right. Where Did I Put My Hammer? I believe that's her name. She is a TikToker, but also she's taken this article from Jersey, a court situation that happened recently in New Jersey in regards to a seller selling their property, and due to the permitting restrictions as far as having to legally get a permit on the property, she was in violation of said things. So the judge requested that she return the home. So we're going to hear what this young lady says on TikTok, and then we'll read some of the article of the pieces that she might have missed. All right. Let me know your thoughts. Let me know how you guys feel about this situation and if this ever occurred with you. Here we go.
Return the buyer's money 3 years after the sale was completed. A federal judge just ordered this to be done in New Jersey. Judith Breslin, a former realtor, listed her home for sale on the Jersey Shore. She had spent over $400,000 renovating it before the sale. This included things like a new kitchen, bathrooms, new HVAC system, and a new roof. All great things, except if done without a permit. Margate, New Jersey is prone to flooding, and a building regulation was instituted called the 50% rule. If improvements are made at 50% or over of the property's assessed value, the entire property must comply to new building standard codes. Essentially, you have to create a whole new house, making upgrades far more expensive. The seller, Judith, clearly wanted to avoid this and did not obtain permits for any of the work done. The buyers paid $1.5 million 3 years ago. And after closing and taking possession of the property, relying on the seller's warranty and disclosures, the seller said they were not aware of any code violations. The seller also failed to disclose issues like mold, water damage, and issues with the floor joists that a previous buyer found and backed out because of. During the case, the seller admitted she was aware of these things and did not disclose them. The buyers filed a lawsuit to sue the sellers, and under a federal judge, they just won. The judge voided the sale. The seller will have to give back every penny of the $1.5 million, and the seller gets the home back. When you are selling a home, disclosure is one of the most important things you need to do. It is much better to scare off a buyer during the buying process than be sued 3 years later and have to come up with the money you probably already spent. Lawsuits like this one become more prevalent in a declining market. If the value of that home had gone up in 3 years, the buyers were able to sell it and make money, even while disclosing no permits were pulled, it's probably the route they would have taken. But in a declining market, anything is fuel for a lawsuit. So when you're selling, be honest, disclose, don't let anything come back to bite you in the butt 3 years later.
So as you heard what happened in regards to that situation, hey, what's going on, Corey West? Said, hello, how are you? How have you been? Was your week? I've been okay. I just made it back down to the state that I live in, and so I've been okay. It's just very exhausted and tired, and just trucking along, getting through the week and doing through the days. There's a lot going on, but I'm making it. Hopefully, you're doing well as well, Croy. So yeah, in regards to that particular situation, as you heard the young lady said on TikTok in regards to that seller, and we'll also pull up the article that was in Yahoo. So if you guys are just joining us as well and you missed that, what the lady said on there, we'll skim through this real quick. But one of the biggest things that I noticed here and that everybody should do is that as a seller is disclose properly, right? A lot of people do not lie about any type of disclosures. When it comes to this particular seller, the thing that kind of makes it even worse is that this seller was a realtor as well. And so some of the legalities per se, or the things around when it comes to selling your house, especially if you homeowner occupy the house, you have to provide said seller's disclosure. And every state is different, but typically the states want you to provide a seller's disclosure if you lived in the property. In the state of Georgia, people have to, if you lived in the property, it's actually interesting. So down in Georgia, you don't have to disclose per se. But through a disclosure, you can do verbal. It's very interesting in Georgia. But as a good realtor or good real estate professional, you're always going to tell your clients that we need to see what the disclosure is if this is a homeowner occupier. If they are an investor or a corporation, they don't have to supply you with a seller's disclosure. They can give you a latent defect disclosure. So it's very interesting how things work, but you want to make sure you're provided with such when you're buying a house, because you want to see, if possible, and if people are honest and truthful, what the house might have experienced prior to you moving in or buying that house. Corey said, yes, driving to Tucker, Georgia on Friday. Okay, well, have a safe drive. Get to Tucker, Georgia very safely. You're going to basically the east part of Atlanta, on the east side, on the east side of Atlanta. So have a wonderful time in Tucker. Enjoy yourself, and be safe when you drive. And so we'll skim through this real quick in case anybody's just joining us about this part of the what we just went through with the young lady talking on TikTok. And we just want to touch on this real quick, because the purpose of me talking about this prior to the foreclosure stuff that we'll talk about is because you need to know the guidelines, the rules, the regulations, and the county and the state in which you are selling a house in, because you don't want to end up like this seller and have to give back $1.5 million, especially if you went and bought a house, because you might not have the money. So it says renovations to New Jersey Shore home without a permit just cost these sellers $1.5 million. And then we'll scroll down here real quick, where she kind of skimmed through. She said a federal judge has voided $1.5 million sale of Margate City home after finding that the sellers knowingly concealed renovations made without a permit. It says in an opinion issued September 15th, the court ruled that the sellers fraudulently induced the buyers into purchasing the 4-bedroom Tudor-style home in Margate historic Marvin Gardens neighborhood. And in her rulings, U.S. District Judge Karen M. Williams ordered that the full purchase price be returned to the buyers. She said the ruling stems from the seller's failure to disclose that they had spent roughly $400,000 on extensive renovations, including a new HVAC system, kitchen, bathrooms, and roof, without obtaining permits. the sellers William and Judith Breslin potentially exposed buyers Vince and Teresa Novelli to demolition orders or steep fines, the ruling said. The upgrades trigger Margate's 50% rule, a local building regulation that requires any home with improvements exceeding 50% of its asset value to comply with modern construction codes. So basically, again, as the young lady said in the video, they have a new building codes in place due to a certain rule, and that's all in regards to the properties and being, I'm guessing, close to the shoreline. I don't know much about this part of New Jersey with real estate, but this is some of the guidelines. So again, if you are renovating your property, just make sure you have to, if you have to obtain permits to do it correctly. So even if you are as a buyer or going into a house and you're looking at a house and you notice that the garage has been converted into a bedroom, always ask the realtor to ask the listing agent for said permits, or you can go down here. What I do sometimes in the public records, we can go to the backhand, and in the public records, it'll state if a permit had been issued, or but typically I tell most people, ask the agent to ask the listing agent, and they should come up with that, because when you sit down with your client and if they made any renovations that needed permitting to be done, then they should be talking to that with the seller. So if there has been a garage converted into a bedroom, that's going to need a permit in the state of Georgia. Because you don't want to buy said house and then when you go to sell it in the future, if another buyer comes across and realizes that that particular thing isn't permitted, then you're liable to pay for that permit on that addition. So just be mindful when you're doing your due diligence. And again, because Georgia is a buyer beware state. I'm not sure what Jersey is, if it's a buyer beware state, but we'll look it up real quick. But Georgia is definitely one. So it says, in common in flood-prone New Jersey towns, the rule is designed to protect properties in vulnerable areas. As she mentioned, it requires sustainability renovated homes to meet current safety and structural standards as if they were newly built. According to the court's opinion, Judith Breslin, a former real estate realtor, and this is the thing about it, she's a former realtor, so she no longer holds her license. She's a former realtor, but as being a former realtor, I don't know what part of, I don't know how much she was embedded into real estate, because some people get their real estate license, they realize it's not for them, and within a week or so, or a month or two or whatever, they kind of disappear out of the business, and they don't really fully dive into the real estate, the knowledge, the information, the education. And with that being the case, you have a lot of realtors out here who have a real estate license that don't really understand real estate fully. And I don't want to, badmouth them, but there's a lot of them. And that's just in any job. You have a lot of people in job positions that don't fully understand their position. Attempted that she was aware of the rule and intentionally avoided seeking permits to prevent triggering its requirements. So she knew of the rule and she intentionally avoided seeking permits because she didn't want it to trigger those requirements of her having to pay said money. Breslin also acknowledged that the home violated the rule, but falsely stated in the seller's disclosure that she was unaware of code violations, the opinion said. So she knew that so she basically lied. She lied. The judge noticed that the violation could subject the Novellis daily fines up to $1,250 or force them to demolish the home to bring it up to code. So basically, they would have been forced to tear the whole entire home down because it would have to have been brought up to code. And of course, as a buyer, you don't want to buy a house and then turn around and realize that, oh, I have to demolish the house. And that's even, again, if certain additions are made into a property. Say if you have a garage, again, and you're trying to convert, say if you have a carport and you're trying to convert the carport down here in Georgia to a garage, people come around, they're like, oh, you don't have the legal permit to do so. And this actually happened to one of my friends, that they didn't have the legal permit to do so. And the county basically told them that you had to tear it down and convert it back to what it looked like. And you had to basically put a work stop order on said property until the permit was issued. The court also found that the Breslins failed to disclose serious structural and moisture issues flagged in inspection reports from a previous buyer who backed out of the deal. So that's another thing you guys got to be careful of, because if it went under contract before, typically if it backs out, it could be several reasons why people came out of contract, right? But in this situation, like they mentioned, it came out of contract because of the moisture, possibly mold damage, not sure, structural issues. So they knew already that these were issues and they were supposed to disclose that going forward. Once you know the information, and particularly structural, moisture, all those type of information, you're supposed to disclose that in the seller's disclosure. And then you can also put it inside of a small box if it was remediated, different things that happen in regards to that. It says those reports cited rotted joint floor joists, termite damage, mold, and stucco defects. The Novalis purchased the home as is in May of 2022, relying on the seller's representation. After discovering the violations and defects, they sued to rescind the sale. Williams granted a summary judgment in the favor of the Novalis, voiding the contract and ordering full restitution of the purchase price. So they got lucky because of the stuff outside of just not the disclosure part, but also the situation of that coding. So with that coding happening over in that Jersey Shore area, they got lucky through that judge that they were able to dispute, get their money back, and actually they had to give the house back to the seller. So they got really lucky and blessed. However, she denied a claim for breach of contract, finding and said that the agreement was voided from the start. It said the Breslins were represented by the law firm, so that's basically talking about who they were represented by. So I guess not hindsight, but I guess in a situation like that is be mindful where you're purchasing a house at. If you're a seller, always tell the truth. If you're a homeowner occupier, do not lie, because you don't want to get caught up in a situation similar to this particular young lady and her husband. And then also if you're a buyer, depending on what state you're in, well, every state really, do your due diligence, ask your realtor, and really look outside. Even if you have a realtor, you should always on the backhand do your due diligence too. Just don't always rely on a realtor. You want to also do your due diligence as well. So, and then you and a realtor can compare notes, right? But you want to also do your due diligence as much as you can. And I know sometimes a realtor can dig a little deeper than some of like the consumers, but if you want to do as much as you can on the backhand, and then you and the realtor can compare notes, you're like, oh yeah, that's what I saw. That's what I know. It's things like that. So, but it's a very interesting story. So the moral of the story, again, is to make sure that if your account, make sure before you do any extensive work to your house, that if it needs to be permitted correctly before you try to go and sell the house. What's going on, Kevin? What's going on? Kevin Jefferson, the People's Lender. He is going live tonight at 8 o'clock. So once I'm finished over here, I'm going to jump over to his live. If you guys have not gone and subscribed to his YouTube channel, please go and hit his YouTube channel up. He has great information, a wonderful lender. He was on over here before we had a great conversation, and he is going live tonight, I believe, at 8 o'clock. So definitely join him 8 p.m. Eastern time to give him, so he can give you guys some more good information around lending. All right, so now we are going to drop. Let me know if I'm going too fast for people. I just don't want, if it's too fast, I'll slow down, but let me know. So what we'll do is now we're going to jump over to here. So I just want to talk a little bit about foreclosures. I'm not going to talk about what the percentage of foreclosures is going on, what things are happening. I'm just going to actually show a gentleman who I believe he is a I don't know if he's a hard money lender. I don't know what type of lending he does, but he lends money to people to buy. Sorry, y'all. He lends money to people to purchase properties. So we're going to dip into him real quick, and then we're going to talk about foreclosures. I'm going to talk about experience, that I had with a client who decided to go into foreclosure, and then we're going to talk about what I had a conversation with recently within a classroom in regards to around foreclosures, and when you foreclose, that sometimes you might have to pay capital gains or some type of tax when you foreclose or short sale, different things like that. So we'll dive into that, but we're not going to dive into like numbers per se, because we just going to try to educate around different topics instead of always reading the news articles and what's happening outside of what we just did. We just read the one news article, but okay, let's jump into this real quick. I don't know this person, but I found this on Facebook, and like I said, I think he is I'm going to show you the picture real quick. I'm bringing it up. Thank you guys again for joining us this Sunday evening. If you're new to the channel, don't forget to subscribe to the channel. If you're coming back to the channel, don't forget to hit that like button, hit that notification bell. I appreciate you guys being here on a Sunday. You can be anywhere in the world, and you come to jump on this channel for us to have great conversation about real estate. All right, so while this comes up, okay, let's say, hey, Lang, what's going on? Good evening, good evening. All right, so this is what I found on as I was scrolling through Facebook. It says Morrow Townhome. So this is in Georgia, Morrow, Georgia. I loaned $175K on that. On Morrow Townhome, I loaned $175K on that I had to foreclose on. I spent $15,000 getting it ready to list on the market. It's listed now for $229K and just got an offer for $210. After all the realtor fees, holding and closing costs, I will break about even on a deal most people might lose on. He said, I foreclosed on 4 homes this year so far out of over 250 loans that he has given out or originated, but I think he's like a hard money lender. I'm not fully sure. He said, I made decent money on 2 of them, broke even on this one, and lost a little on the 4th. So I don't know this particular gentleman, but I found this very interesting as far as talking about the foreclosure stuff. And now we're going to actually see a video in regards to him talking about this particular property. He kind of goes inside the house, has a little talk, and then we will get into some education a little bit around the foreclosure and short sale. So let me go. That's why all that noise you kept hearing, it was me clicking on the guy by accident. So this is his TikTok.
I recently foreclosed on this house and I just finished the rehab. We're gonna go inside and see what it looks like. I loaned $175,000 on this property. I put about $15,000 into it with all my fees and costs. And now I have it listed for $230,000 and it should sell soon. Nice faucets. I like it. There's 3 bedrooms upstairs and 1 bedroom downstairs. Yeah, the foreclosure process in Georgia is pretty fast. It takes 30 days to foreclose once you decide you want to foreclose. You just got to put an ad in the county paper, and 30 days later, you can foreclose on the first Tuesday of the month. I recently foreclosed on this house, and
so that's the same gentleman in regards to him, the house that he was mentioned in the post. I wanted to make sure I had the video there too, because we want to make sure that people are not just, leading us with false information and they're showing us the actual proof of what is happening. So I just wanted to make sure I showed that video that corresponded with what he wrote on the Facebook page. Okay, so nonetheless, we are going to get into foreclosures. Again, I'm just a real estate agent. I'm not, well, I don't want to say it again because I never mentioned it before. I'm a real estate agent. I'm not a lender. I'm not a person who goes and forecloses on your property. And I don't do auctions. I'm not an auctioneer, all those things like that. We're just educating over here in real estate to understand. And again, every state works differently. So we're going to talk about Georgia, of course, because that's where I'm currently at. But every state works differently. And then we'll just define what a short sale is, foreclosure, a deed in lieu of a foreclosure, and things like that. So let's first look into Georgia, and we're going to confirm what the gentleman said in regards to how Georgia's process works as far as foreclosures. Again, I'm not here talking about how many houses or properties are currently foreclosing right now. We are just getting into the whole foreclosure thing. We're going to talk about this, talk about how Georgia is a non-judicial state, and then we're actually going to jump over real quick to see a video in regards to Baltimore around foreclosures happening there, and then we'll jump back into some of the terminology. All right. So hopefully that helps everybody, and hopefully it don't become too teachy. But I appreciate you guys being here. All right. So in regards to Georgia, it says the foreclosure process, as he made mention, we're not going to read this up here because we're going to get through this in regards to Georgia. It says Georgia is a non-judicial foreclosure process, allows a foreclosure to be completed much faster than any other state. Foreclosures occur in the state of Georgia on the first Tuesday of each month. So if you guys don't know, if you haven't watched any of the auction videos I've done, foreclosure videos, every auction happens the first Tuesday of each month in Georgia, in every county around the same time, 10 o'clock in the morning. The auctions kind of start off. So it's kind of hard to go from one to another one because Georgia is so spread out. So that's why when it comes to the auction videos I've made on my YouTube channel, I don't have a lot of them because it's just a lot of running around to go from auction to auction. It says, and the mortgage company must give you a notice and publish the foreclosure in a local newspaper 4 weeks prior to the foreclosure. It says the foreclosure is followed by eviction process of 14 to 30 days, and it begins with a 120-day pre-foreclosure period followed by 4 key steps. So the first step is the pre-foreclosure. It says before foreclosure officially begins, you must be over 120 days delinquent on payments. So that's the first thing. This is a general rule under federal law, but there are exceptions. So there are exceptions to every rule, which we know in life. There's exceptions to every rule. but typically they want you to be over 120 days delinquent. I don't know if Kevin is still in the chat, and maybe he can clarify if that's correct. It says day after the late payment to the beginning of the foreclosure is often called the pre-foreclosure stage. This 120-day period allows you to avoid foreclosure and submit a loss mitigation application. During this time, the lender cannot create a foreclosure notice or begin filing for a foreclosure. They must provide a breach letter and loss mitigation options such as a repayment plan or a loan modification. The next thing is the 30-day notice of intent to foreclosure. The lender must send a letter of intent to foreclose 30 days before scheduling a foreclosure sale. This notice must include the name, address, the telephone number of the individual or the entity with authority to negotiate, amend, or modify the mortgage terms. It also may include a copy of the published advertisement, which must be sent by registered mail, certified mail, or overnight delivery, with the return receipt requested to the designated address. If the notice does not meet these requirements, it can be deemed invalid, and the foreclosure can be delayed or canceled until all notice requirements are met. The next thing is you have to publish it, notice of sale. Before proceeding, the foreclosure sale must be publicly advertised at least once a week for 4 weeks in an official newspaper in the county where the property is located. The advertisement ensures prospective buyers are notified of the sale. Blah, so that, and then it's talking about reinstating a loan, and it's different processes and everything. And it says foreclosure sale. If the lender does not receive the money owed, they will continue with the foreclosure sale on the first Tuesday of the month. The sale typically takes place at the county courthouse. The lender often makes a credit bid, which is the amount of the debt owed at this time of the sale. And so this is what I found interesting, because experiencing this recently with a former client. Their particular property went up and they owe a little bit more, and they to the bank per se, and they started to bid at 150, and they bidded this property up, and then all of a sudden it looked like the property closed out, and then they turned around and they had auction date set again. So I don't know if they started low and they were trying to get that number as it stated here, and then when they didn't get it, they just didn't take the money. I don't know, but I'm actually going to call the auctioneer tomorrow to kind of find out more information in regards to what's happening. Hey, what's going on, David? David is living in Omaha, Nebraska. If you guys are new to the channel or watching right now, David has a YouTube channel as well. Please go over and support David Matney, wonderful realtor out in Omaha, Nebraska. Wonderful information, wonderful videos. Always a great, he goes live Tuesday, 8 p.m. Eastern time, my time, but he's on a Central time. So go check him out Tuesday live. Wonderful information over with David as well. And so we go more and more down here, and we're not going to dive deep into all this, but Georgia does have a redeeming the property situation where if it does go into foreclosure, that the owner of said property has 12 months to come back and redeem said property, although there is interest put on said redemption. So if somebody say the property bid at 350, the owner would have to then pay the 350 plus the interest that goes on top of that 350. And they have a year to redeem said property. But I don't think that's for foreclosure though. I think that's for taxes. Let me make sure, because every state is different. Let me make sure. Let me check before we start saying something, because I think that's just for the taxes. They might have just put that in there. Let me see. Redemption of foreclosures in Georgia. Redemption of foreclosure in Georgia. I know that's for the taxes a year. Yeah, it says in Georgia there is no statutory right to redeem a property after a non-judicial foreclosure. So just want to make sure we clarify that, because I read that and I was like, I don't think that's correct. So in regards to redeeming said property, the 12 months is for a tax sale. It's not for a foreclosure sale. I was like, I don't believe that's for foreclosure, because once the foreclosure is gone, it's gone. The tax is the redemption. All right, I just want to make sure I clarify that with you guys. So I was like, that is incorrect information, Borrow and Associates. Or it's correct, but it needs to be clarified. And maybe I missed it where it said taxes up here. Maybe it said taxes up here somewhere. But anyway, so that is a little bit about the foreclosures in the state of Georgia. And now we're going to talk about real quick what is judicial and non-judicial foreclosure. So when people go to the closing table down here as a buyer and you're buying a property, the attorney tells you, and I don't know, people are hearing what the attorney is saying. They do tell you, they go through the documents and they do let people know that the lender, the bank or whatever can come and foreclose on your property, and you won't, it doesn't require you to go to court for them to take you to court to foreclose on the property. So Georgia is a non-judicial foreclosure state where you will not get a court hearing in regards to foreclosing on your property. Some states are judicial where they will get a court hearing. So let's read real quick. It says, so you guys can get a clear. Says judicial foreclosure. The lender will bring a lawsuit in court and the judge will review the evidence submitted by both sides. They may hold a hearing to decide whether the homeowner is in default on the loan, and then the homeowner can try to reach a settlement with the lender before a hearing to prevent the foreclosure. If the parties cannot reach a settlement and the court finds in favor of the lender, the court will enter a judgment of foreclosure. So you guys can go read more and more in that in regards to that. So that's for the judicial foreclosure. And then Georgia is a non-judicial foreclosure state. So the lender will not go to court at the start of the process, but will pursue a foreclosure with assistance of a foreclosure trustee. This is a neutral third party that may be listed in the deed of the trust attached to the home. The process of non-judicial foreclosure varies more widely from state to state than the process of judicial foreclosure. So again, this is not to be a Debbie Downer, but you guys need to understand, how does your state take possession of said property if you were to go through a foreclosure situation? Understand it clearly. Talk to the attorneys when they're giving you this information. Again, if you are in the state of Georgia, most people may not hear it when they're at the closing table, but we are a non-judicial foreclosure state where they will not, you don't have to, you won't be going to court. They'll just foreclose on your property. If you're not making your payments, you're behind, different things like that. David said, we are a non-judicial state too. So Nebraska does a similar thing. You're non-judicial, you guys. So if you are buying real estate over there, understand the process. Of course, we don't want to be doom and gloom over here, but we want to provide you with valuable information so that way you know how to protect your asset, right? That is the purpose of the chat tonight. All right, so now let's go into this video in regards to Baltimore real quick. Yes, like David said, please hit the like button. Let us, so we can get through this algorithm. More people can join in this discussion. It's a much needed discussion in regards to real estate, especially if people are buying in this current economy. You just want to know how to protect your asset. So thank you, David. Yes, hit the like button, and we're going to listen to this real quick, and then we'll jump into more discussion.
It's a vacant home problem. There are investors, large and small, ready to buy up those houses, and one way they can finance a loan is through a debt service coverage ratio, or DSCR loan. So in the last few years, there have been over 700 such loans. But then came mass foreclosures. So what happened? That's the subject of a new investigative piece by our media partner, the Baltimore Banner. Reporters Jack Bologna and Sahana Jayaraman join us. Thank you for joining us. Really interesting, very elaborate report.
So real quick, before we go into the video some more, I'll just do this now so it'll make more sense. And then we'll just start. So people, I believe, I forget who mentioned this last time about a DSRC loan. I think it might have been, I don't know if it was Debbie or somebody. No, it might have been Miss H that joined us that one time. So we'll get a little quick insight about a DSRC loan. Again, I'm not a lender. If you want to know more about this, go to a lender. But it stands for debt service coverage ratio. It's a loan. It's a type of loan, basically a real estate investment mortgage that qualifies borrowers based off of their property income generating potential rather than their personal income or employment history. So 9 times out of 10 investors, well, usually not 9 times out of 10, 10 times out of 10 investors are using this type of loan to basically buy properties, and they're basing it off of what they are looking at when it comes to renting out said property. It says how a DSCR loan works. Qualification is property-based instead of W-2s and tax returns. Lenders evaluate the property's projected rental income and its ability to cover its own debt payments. It says the DSCR formula, lenders calculate the DSCR by dividing the property's annual net operating income, the NOI, by its annual mortgage debt, principal, interest, property taxes, and insurance. And then it says a DSCR or 0.0 or higher is ideal. A ratio basically saying if you have a 1.1 or higher, 1.1 or more indicates that the property generates enough income to cover its mortgage payments, which lenders view as less risky. And then it goes more and more into understanding DSRC, your credit requirements, different things like that. But I figure we throw that in real quick since that's what they're talking about in regards to the DSCR loan. Let me know too, guys. Again, I know my dad said earlier that the sound was good. Just let me know. Make sure we're not clipping because I am using the microphone. So I just want to make sure the sound is good. And there's no clipping because when the video, of course, saves to the channel, and if people want to watch it back, I don't want them to have to worry about any type of weird sound with the audio. All right, let's share this again and let's go back into this video.
You did. All right, so let's start out with what happened. Who's at fault here with all these foreclosures?
Yeah, it is a fascinating tale. It starts actually in New York. A small group of investors essentially bought up a lot of homes in Baltimore using this newly popular, virtually unregulated type of loan that has been really successful for some folks to kind of build a portfolio and manage homes. But what it allowed them to do is really kind of buy a lot of homes quickly at values that were sometimes 2 or even 3 times more than what they had last sold for.
Aha, so then we had the foreclosures. Who's at fault?
Yeah, so in June, Wall Street firms circulated these lists, these blacklists among local mortgage originators that listed the New York buyers along with several LLCs and companies that they managed, and they used those companies to acquire the loans and acquire the homes that they bought in Baltimore. Some of those blacklists curtailed lending altogether in the city.
And you're saying some of these, they were overvalued, that it was actually maybe the appraisers in conjunction with the lender who may have caused the problem?
Well, yeah, we should be clear. You know, what we found is we were able to review a lot of some of these confidential loan documents, about 88, and we found that in those 88, there were only 2 appraisers for all 88 of those loan applications.
So basically what they're saying is that they feel like the appraiser and the lenders were in cahoots with these particular investors to buy said properties, overvaluing the properties, basically giving it a number that it should not have been given in order for them to secure said loan from the lender. It had to appraise at a certain amount. If not, of course, we know if it doesn't appraise, the lender will only give you what the property is worth. And then if you are trying to buy it at a higher price, you have to either pay that appraisal gap right there, or you'll have to buy it at what the property is worth if you're using lending options to finance that property. And this gentleman and this young lady are basically saying that there was some type of possible fraudulent stuff happening in which the lender and the appraisers were in cahoots to make sure said property appraised accordingly.
And when it comes to appraisals, it's supposed to be kind of a blind process. It's unusual to have the same 2 appraisers repeatedly.
Right. Those appraisers were also on those blacklists.
We're on the blacklist, okay. And you say that this is in Baltimore, but that this is happening in other cities as well with these same loans.
Well, we should say that a lot of people are using the DSCR loans responsibly and totally normally, and they've been a great product for some investors to responsibly buy homes. But yes, DSCR loans, I think, are becoming very popular throughout the country.
That's right, yeah.
So what's going to happen now? I mean, you have these homes that go into foreclosure. Meanwhile, there are people, responsible people, who would like to buy them and, as you say, create a portfolio.
So, hey, what's going on, MHOA? He said, on the road now, heading back to Denver, listen on the drive. All right, no problem. Be safe. Have a great drive back to Denver. And I appreciate you being here, and be safe on the road. But in regards to this particular thing, when it comes to, again, this is an investor. These are investors. So these were investors out of New York. I don't know if they were a company or whatever, but they were investors out of New York. They decided to buy property in DC. They used the DSCR loans through a lender, and then basically after a while, I guess they couldn't sustain said property off of what they thought they would make, and they are foreclosing. So what some people realize is that some of these foreclosures that are happening, because when I look up at the foreclosures that come on our list down here, some of them are basically companies that are foreclosing. You do get a couple homeowners here and there that are foreclosing. You get independent investors as far as mom and pop investors that are foreclosing. So you're getting more. I'm seeing more on the foreclosure list, more LLCs, more mom and pop investors that are kind of foreclosing on said property. And I'm seeing less homeowners, even though we do have some homeowners that are foreclosing. It's not at the rate as the investors, and which is very, very interesting. But it's not interesting. I don't want to say it's very interesting because, as we all know, in the great financial I don't want to say crash, but it was the great financial crash as far as housing, that a lot of builders and investors and everything, they kind of folded and they were foreclosing around that time as well. Corey West said, Clark, would it be favorable for all the states to allow judicial process before foreclosure in the case that a lender could be engaging in unlawful activity toward the owner? It could be very helpful because you don't know what's going on in the process, right? You don't know what type of illegal stuff is going on. You don't know what people are doing underhand, right? In this situation, it seems like and as far as the Baltimore situation with these investors, I have a feeling that they are trying to possibly take them to court, maybe in regards to fraudulent, like a fraudulent scheme or a fraud scheme or some type of situation that they feel like everybody was in cahoots, from the investors to the lenders to the appraisers. So I don't know if everybody's going to end up in court because of that. Again, this is just my opinion. It's not the truth. I'm just basing off of what I'm hearing from the video. But it could be a good thing to do that. I feel like some states probably don't want to do that because they don't want to keep prolonging the process. So they'll just we just rather just be able to go in there and do what we got to do and take what we got to take. But you just, like you said, Croy, we don't know, if the lender is engaging in any type of unlawful activity towards the owner. So it could be a good thing for them to actually have a day in court where they can discuss said situation. Hey, son of Joxer, how could you possibly prove that a property has been overvalued? Isn't appraisal such an educated opinion? Exactly, you're correct. An appraisal is an educated opinion. You really can't. I don't feel like you really can prove it, right? I guess to prove it is based off of what the comparables are doing around it in the area and basing it off of the specs. 3-bedroom house, 2-bathroom, different things like that, in regards to condition and stuff like that. So that's how I guess you can quote unquote prove the value without it being overvalued per se. But it's always interesting when it comes to appraisals, because when you look into certain communities and certain areas, when people are selling their houses and you have, it's a community right now that I helped somebody sell a house in, and this person bought this house. They just put it up on the market, but they bought the house around probably 3 years ago during the pandemic for $920,000. So in this particular neighborhood, there were no other properties selling for that amount of money. And it sold for $920,000, and the guy did buy it cash, so he might not have gotten an appraisal done. I'm not sure, because when you buy it cash, you don't have to get an appraisal done. So I don't know if he got one done or not, but now he's listed it on the market because I'm guessing he's trying to move, and he has it for $1.2 million. Oh Lord, I got a net here. Sorry, y'all. He has it for $1.2 million, and there's nothing in the area that signifies the $1.2 million. So in regards to an appraisal, like you're saying, isn't an appraisal just an educated opinion? I really want to see how they're going to find said value to basically be able to connect it together in regards to saying this house is worth this amount. I know, and I'm not an appraiser, I'm not a lender, but what I see sometimes is that if a house, let's say if a house is $1 million, if the house is $1 million, but everything else in the neighborhood is $700,000. But if somebody comes in and possibly puts down, let's say $700,000, then the appraisal will still go through with the lender, because now they're only covering the $300,000. So it's almost like a risk adverse situation going on. It looks like it's more of a like a risk adverse. So it's like, okay, this house we know is only worth this, but because you already put down $700,000, even though we know it's not worth $1 million, but you put $700,000 down, now all we're doing is really covering the $300,000, which means that even though the property's in the neighborhood $700,000, you're only $300,000. So the risk is no risk per se there as far as overvaluing the property. That's how I kind of look at it when I see them doing certain things. But again, the one thing that we know about America is that we are the people in the world, just the world period globally. We put value on items. We put our own value on items, right? So what we look at stuff as far as like, what do we value this as? And that's why you have some buyers that are trying to buy houses now with sellers, and they're like, I don't see the value of your house being $800,000. I feel like your house is only worth $600,000, right? Because you as a person put the value on said property or on said items, anything you buy, right? When you go to the store, you're like, I'm not paying for that. That doesn't make sense, right? So we as people put value on items. So yeah, but that's a good question, son of Joxer. He said, so at least show their homework. Yeah, exactly. It's like show the homework, lay everything out. Like you can look at the appraisal report. I don't know if people realize this, that an appraisal is actually for the lender. The appraisal is actually for the lender, even though the buyer is quote unquote getting the appraisal done on their side through the lender. The lender actually is the one paying for said appraisal, but then ultimately you do pay for the appraisal too, because the lender puts that cost into your closing costs. But that appraisal is really for the lender. It's not really for the buyer. And you can actually, get the appraisal report, but it's more for the lender, not really for the buyer, because they're basically trying to protect their asset, because it is an asset in which they are lending money to. All right, so now let's jump into, let me see, make sure I did everything, because I started writing notes down so I can make sure we get everything out the way, so I don't feel like I'm not telling you guys what we wanted to kind of talk about tonight. So I just wanted to break down real quick, if you guys don't know, and I'm pretty sure everyone knows, and I just did a quick Google thing, so we'll just read it real quick as far as what a foreclosure is, what a short sale is, and then we'll get into the last topic. Let me know your thoughts, how you guys are feeling about this information, this conversation. So it says a foreclosure and is a legal process a lender uses to take back a property when a homeowner fails to make mortgage payments. So as we all know, if you fail to make your mortgage payments, the lender will foreclose on said property. All right, basic, very sweet, straight to the point in regards to what a foreclosure is. And now I want to jump into a deed in lieu and for a foreclosure. If you guys have never heard of a deed in lieu foreclosure, this is typically when you as a person voluntarily give back your house to the bank or the lender. All right. So some people do this. They abandon the property and they give the property back to the lender. So it says a deed in lieu of foreclosure is a voluntary agreement where a homeowner gives the property back to the lender to avoid formal foreclosure process. This allows the borrower to be released from most of all of the mortgage debt and can help their credit score recover more quickly than a foreclosure. The lender agrees to forgive the remaining balance in exchange for the borrower transferring the deed and keeping the property in good condition, and may also offer relocation assistance. So yeah, so if you guys don't know that, if you do decide to do a deed in lieu, the lender can sometimes give you cash for keys, can kind of give you some money and in regards to relocating, getting an apartment somewhere else to go. Again, this is all stuff you have to talk about with the lender. They do require you to write, a hardship letters, different things. You have to write stuff out, talk to them, and see what you have to fill out, applications, different things like that. But that is a deed in lieu of foreclosure. A little information on that if you guys never heard of that. And then we are going to jump over to what a short sale is, because this is also something that I'm seeing as well in regards to people short selling in this particular market, because people might have bought homes 2-3 years ago. The market, depending on where you're at, because I don't know where you're at in Georgia, the market is declining or it's flattening out. And now people are trying to sell at a higher price because they what I'm noticing is that a lot of these people have been refinancing on the back end. They've been doing cash out refinances. They've been doing second on the first as far as a mortgage, and these people need to be able to clear both of the loans or clear out the higher debt that they incur from the refinance. and they are listing the house higher than what the neighborhood is indicating, allowing them to sit longer on the market, and most of them will probably end up having to possibly short sell if they don't know how to negotiate it properly to get out of the sale for the home. So a short sale says a short sale. Just say what a short sale is, or just, oh no, sorry, that says after a short sale. That's good. Let's go from this one. Stop this one real quick. Let's go to what a short sale is. Sorry, you guys. Thank you for being here again tonight. If you're new to the channel, don't forget to subscribe to the channel. Hit that like button, hit that notification bell, and I appreciate you being here. And if you're back to the channel, it's always great to have you guys here on the live to discuss real estate. In regards to real estate, sorry. So let's see. So right here, what a short sale is, this is a short sale is a real estate transaction where a homeowner sells their property for less than the mortgage amount owed with the lender's approval to accept the lower price. So again, you have to get an approval from the lender. You can't just say, okay, I just want to short sell my house. This, like, just like for a deed in lieu to the foreclosure, all those things, they have to be approved by the lenders. So you have to have the short sale has to be approved by the lender in regards to accepting that lower amount from what you owe on your mortgage. You just can't automatically go and do a short sale. It says this often used to avoid foreclosure when the homeowner is underwater on their mortgage. It says the process is lengthy and complex because the lender must negotiate with the homeowner and any other lien holders. There can be lengthy waiting period before the sale can close. So yes, he has to do a lot of different things, but that is what a short sale is. So a short sale typically is when you owe more than what the house is worth, basically, if that makes sense. All right, so what people probably don't know what happens is if you short sell your home, or if your home forecloses, or you do a deed in lieu of foreclosure, you might be implicated to taxes, paying taxes back on the sale of the property. And this is something that I recently learned when I was attending a class with a lender and other people in regards to their doing some short sales and everything. And I knew about the capital gains, but I didn't realize that the IRS also hits you with a 1099-C. But there's ways in which you can be excluded from said things. But if you guys are going through a short sale right now, if you're going through foreclosure process, if your home has sold through the short sale, through the foreclosure, you are still possibly liable for your taxes at the end of the year, capital gains tax, and another tax of cancellation of debt from the IRS in the form of a 1099-C form. There are some ways to exclude yourself from those taxes, and that's what the people did in that video that we saw in Baltimore, those investors, right? They, if you guys heard them say in the video, they foreclosed on the property, then they claim bankruptcy. So that's one of the ways in which you can try to avoid some of these taxes popping up on you from the IRS is through bankruptcy, insolvency, different things like that. So that tells me that those investors are experienced investors. They understand the process, or they have some type of legality, like a legal team behind them, advising them like what to do. Foreclose on said properties, claim bankruptcy, get a proper discharge of bankruptcy, and be able to not have to worry about the debt and paying those taxes back. But if you do not do that, or you don't want to take that step, you might be liable to pay said taxes because the bank looks at it as a sale of your property. So it says after a short sale or foreclosure, you may have to pay taxes on both capital gains and cancel debt, depending on the specifics of your mortgage and residence. Forgiveness of mortgage debt on a primary residence is generally excluded from income through 2025, but special rules and exceptions apply. It says potential taxes after a short sale or foreclosure. It says for tax purposes, the IRS treats a short sale or a foreclosure as a sale of the property, which can trigger two types of taxes. Of course, everybody knows when you sell your property within a certain time, within a certain time frame as far as years, you are liable for capital gains taxes. It says capital gains tax, you owe capital gains tax if your home's selling price exceeds your tax basis. So it says calculating gain or loss. Your capital gain or loss is the difference between the amount realized and the home's adjusted base, typically purchase price, plus the cost of improvements. It says tax-free exclusions for primary residents. You can exclude up to $250,000 of gain and $500,000 for married couples. So $250,000 is for single people, provided you lived there for at least two of the last 5 years. So you're able to exclude up to a certain amount with your sales if you live there between the 2 of the last 5 years. And then it's talking about deductible. Okay, so the other possible tax implication you might be hit with if you short sell your house or your house is foreclosed on, whether you're doing a deed in lieu or whether you foreclosed on it. It says that the canceled debt income says if the sale price does not cover your mortgage balance, the lender may forgive the remaining debt. So the lender is forgiving said remaining debt. So if your mortgage was $400,000, they got $380,000 through the auction or the foreclosure process when somebody bought it, and the $20,000 is the remaining debt. The lender may, not all the time, but the lender may forgive that remaining debt, that $20,000. Says this canceled debt is typically treated as taxable income unless you qualify for exclusion. So that $20,000 that the lender forgave, they will then give you a 1099-C form, and you will be taxed on that $20,000 in regards to if they quote unquote forgive that debt. Special rules for canceling debt income. So these are some special rules that you can avoid said income. The Consolidated Appropriations Act offers important protections for those who lose a primary residence with certain conditions. Principal residence. For tax years 2021 through 2025, you can exclude up to $750,000 of canceled mortgage debt on your primary residence for your taxable income. So that's a good thing as far as this. I'm not a CPA, I'm not a tax person, so definitely this information we're talking about today, run it through with your CPA. If you are going through the situation, if you're short selling, if you're foreclosing, just make sure this makes sense in the state that you currently live in, because the taxes, in America, every state has different tax laws, tax things, and so you just want to make sure this is correct. But they're saying that you can exclude up to $750,000. So let's say if your house sells for $700,000, you should be good to go as far as being excluded from it. Because if it's your primary residence, if you're an investor, it doesn't look like that will help you to exclude yourself. It says other properties. This exclusion does not apply to second homes or rentals. Okay, so this kind of dived into that. I didn't even see that, so sorry. We basically said that already. IRS Form 1099-C. If the lender cancels at least $600 of the debt, they are required to send you and the IRS a Form 1099-C, cancellation of debt showing the amount forgiven, which we talked about earlier. If that lender cancels at least $600 of the debt, so $600 plus more, they are required to send you said 1099-C. Reduce home bias. Excluding canceled debt reduces your home bias, which would increase capital gains tax if you sell the property later through less relevant after foreclosure or short sale. Also, I don't know if they have it in here, but bankruptcy is another form, like we stated earlier, but they don't have it listed here. Insolvency exclusion. It says if your liabilities exceed your assets immediately before the debt was canceled, the canceled debt income may be excluded regardless of principal residence rule. And this exception is reported on your IRS Form 982. All right, so those are just some different things. If you guys didn't know, if you want more information in regards to that, I would say reach out to like your CPA, because these are all tax questions. So you want to make sure you get more information, more knowledge around that through your CPA. You can also, if you're going through the process of a foreclosure, a deed in lieu of foreclosure, or a short sale, you can ask the lender some of these questions. The lender might not provide you with said information around these particular questions because they're just lending you the money. They're not in the business of real estate. They're in the business of financing. So they might not tell you all of this information, but I felt like, this is a real estate channel where we provide you guys with information, education, knowledge over here. So it's always great to be prepared just in case. You don't want nothing to pop up on you down the road after you feel like you have given your house back, foreclosed on your house, short sold your house, and then you're like, what the heck is going on? So that is basically what we were talking about tonight. I appreciate everybody for jumping on here tonight. It is Sunday. I know a lot of you guys are probably watching football games and different things like that. So we will keep trying to do Sunday night at 7 p.m. If it starts to kind of dwindle where people are like, I need to watch my football game, then we'll try to move it over somewhere else. another time that makes more sense, where football is not taking up everybody's space to learn or listen or have open conversation in regards to real estate. Again, if you're new to the channel, don't forget to subscribe to the channel. If you're back to the channel, I appreciate you guys being here Sunday. Don't forget to like, share, hit that notification bell. And I appreciate everybody who jumped on here tonight. Son of Joxer, Corey West, MH08, my cousin Lang, David Matney, my dad, Kevin Jefferson. And if you guys are still looking for something to watch on YouTube, head over to Kevin Jefferson's channel, The People's Lender. He is going live right now, 8 p.m., and I am about to head over there myself. Have a wonderful, wonderful night. Thank you, Lang. Another great show. Lots of good information, great participation. Have a great week. Yes, you too. Everybody have a wonderful week, and I will see you guys next Sunday, 7 p.m. Eastern Time. Bye-bye.